Today we're going to go into chapter 9, and as you can see from the title, it talks about other income and deductions and other issues. Now, most of chapter 9 deals with other deductions, but it does start off talking about these other income amounts. And we'll just sort of briefly just sort of go through them quickly. The first one talks about sort of pension benefits. So if you are getting CPP or OAS from the government when you retire, when you turn 65, if you get money from a company-sponsored pension plan, remember we talked about RPPs, how if you put money into an RPP, you don't, that is a deduction when you're calculating your employment income. So when you do retire and you basically take money out of your pension from your work, or if you collect CPP or OAS, all those amounts basically get added to 3A when you're calculating your net income for tax purposes. Other amounts that are included, if you put money into an RRSP, which we'll talk about in chapter 10 next week, and when you retire and you take money out of that RRSP, that gets added into income in 3A as well. The textbook also talks about the fact that, generally speaking, scholarships are exempt from tax. So if you ever receive a scholarship from university, or if you received a scholarship maybe when you were in high school, that is generally not taxable. So once again, the beginning part of chapter 9 just sort of talks about these sort of other amounts that would be included in 3A when you are basically collecting these types of income. So not too much to focus on in that respect. As I mentioned at the beginning, the majority of this chapter will focus on deductions. The deductions that we're sort of going to focus on are those 3C deductions that we talked about when calculating net income for tax purposes. So if you remember all the way back in chapter 1 and 2, we said that when we're calculating net income for tax purposes, 3A is positive amounts of business, property, employment income. 3B is the excess of your taxable capital gains over your allowable capital losses. And then we have these 3C deductions. And we said that 3C deductions include moving expenses, childcare costs, spousal support paid, and RRSP deductions. And what we're going to focus on today in chapter 9 are these first three. So this will be dealt with in chapter 9. And then next week, when we get into chapter 10, we'll talk about RRSP deductions. So why don't we just start off by talking about moving expenses? Moving expenses are a 3C deduction when you're calculating net income for tax purposes. Now, there are certain conditions that must be met. And so these are sort of the conditions that must be met in order for the moving expenses to be deductible. So it has to be on an eligible relocation. Basically, you have to be moving to basically start a new job. Now, it could also be if you're, let's say, starting school in another city, that would be eligible as well. But generally speaking, you would be moving to, let's say, start a new job. Now, the move that you make to this new residence must bring you 40 kilometers or more closer to your new work location. So, for example, if you were, let's say, starting a new job in, let's say, Burnaby, and you were living in North Vancouver, and you moved from North Vancouver to Burnaby, that distance is not 40 kilometers or more, so that would not qualify. So generally, we're sort of looking at sort of longer distances. So let's say you're moving from Vancouver to Calgary. That would qualify because your new home in Calgary brings you more than 40 kilometers closer to your new work location. So once again, sort of local moves, let's say from North Vancouver to Burnaby to start a new job in Burnaby, would not qualify. but longer sort of moves like from Vancouver to Calgary, or even Vancouver to, let's say, Chilliwack, that would be bringing you 40 kilometers closer to your new job in Chilliwack. That would qualify as well. Now, the expenses that you can claim, these eligible moving expenses that you can claim, and we'll talk about what those are in a few minutes, can only be deducted against income from the new work location. So if you're moving from Vancouver to Calgary, and let's say you're starting the job in Calgary in December, and so you're only making a small amount of income from the Calgary job for the year because it's in December that you're starting, and your expenses are more than that, then you can only claim the expenses up to the income in the new work location. Whatever you cannot use, any unused amounts, can be carried forward and used in the following year. So those are sort of the general rules that we have to work with. But let's talk about what are eligible moving expenses. So these eligible moving expenses, let's talk about what would qualify. So traveling costs. So let's use this example. Let's say we have a new job in Calgary, and so we're going to move from Vancouver to Calgary. Well, the traveling cost. So let's say you're going to drive from Vancouver to Calgary, and let's say you're going to stay overnight in what's halfway, maybe Kamloops or Salmon Arm. So you're going to stay overnight in Kamloops, halfway between Vancouver and Calgary. The traveling costs, basically the gas expense, also the meals and lodging. So if you're going to be eating during this commute, and also the lodging overnight in Kamloops, those would qualify as eligible moving expenses. Transportation and storage cost. So let's say that you hire a moving company to basically move all your belongings from Vancouver to Calgary. That transportation, let's say when you get to Calgary, they have to store your furniture for a few days. Those costs would qualify as well. And then we have this next one, cost of meals and lodging for up to 15 days near your old or new resident, up to a maximum of 15 days. So what does that mean? Let's say, once again, you're moving from Vancouver to Calgary. And let's say that you move out of the Vancouver rental on, let's say, where we are, March 31st, and you stay in hotel in Vancouver for 5 days before driving to Calgary. So you were finishing your tenancy at the end of March. So you move out at the end of March, but you still need to stay in Vancouver for a few days to wrap everything up. So you stay in a hotel for 5 days before driving to Calgary. That meals and lodging, so the meals for the 5 days and the hotel stays for the 5 days, that would be added to eligible moving expenses as well. When you get to Calgary, you cannot move into your new home yet. So you stay for another 7 days in a hotel in Calgary. Those 7 days, meals and lodging, would count as well, but only up to a maximum of 15 days. If you exceed 15 days in these meals and lodging costs, close to Vancouver, close to Calgary, then of course you would pick the 15 days with the highest amount per day. Let's move on to the next line. Cost of canceling a lease. So let's say you had a 2-year lease in your home in Vancouver that you were renting, and you had to break it because you found this new job. Those costs to cancel the lease would qualify as well. And let's say you were to sell let's say you owned a place in Vancouver, and so you had to sell it. You had to pay real estate commissions. You had to pay maybe legal costs. Those selling costs would qualify as eligible moving expenses as well. What about if you bought a new place in Calgary? Well, the legal and commission cost associated with buying the new place in Calgary would qualify as well, but there's a condition. In order for these costs to buy your new residence to qualify, you had to have sold a residence in your previous home, which was in Vancouver. If you were renting in Vancouver and then you bought a new place in Calgary, those legal costs to buy the new place in Calgary would not qualify because you did not sell a residence from your old location in Vancouver. And then what about this last one here? Or not the last one, but what about this one here? Up to 5,000 of interest, property tax, insurance, and utilities on the old resident. So let's say you were trying to sell your home in Vancouver and it would not sell. And then you ended up going to Calgary. So you own a home in Vancouver, you're moving to Calgary to start a new job. You put the home on the market, it cannot sell. It's a slow market, so it's not selling. But you have to leave to Calgary because you have this new job that you have to start. Well, the home is going to be vacant. So provided the home is vacant, then you can claim up to 5,000 of these expenses. And so basically it's just saying that while you're trying to sell the house, you're probably still paying interest on your mortgage, you're still paying property tax, maybe insurance and utilities. And so during this time that you're trying to sell the house in Vancouver, as long as it's vacant, you can claim up to 5,000 of these expenses as eligible moving expenses. If you have to revise any legal documents, you have to sort of change your address, those sorts of things, those would qualify. If you have to disconnect or connect your utilities, usually there's a disconnection cost when you move out, and then when you reconnect at your new home, those costs would qualify as well. So this is just sort of a list of eligible moving expenses that could be deductible under 3C as part of your moving expenses. Now, this paragraph here talks about house hunting trips. They're not deductible. So let's say you fly out to Calgary before you start your new job to look for a new home. Those house hunting trip costs are not deductible. The flight, the hotel, the meals, those are not deductible. But there is one exception. If during this house hunting trip, you actually acquire a new resident. Now that could be you sign a rental lease or you sign an agreement to buy a new property. So as long as you acquire a new resident, either you confirm a new rental or you actually confirm a house purchase, then the days after you acquire the new residence, the meals and lodging expense would qualify as part of your moving expenses, but the meals and lodging become part of that 15-day maximum. Remember we talked about this 15-day maximum up here? Meals and lodging for up to 15 days close to your old or new residence. If you do a house hunting trip, let's say you fly out to Calgary for 5 days, and let's say at the end of day 2, you sign a lease to rent a place. So you've confirmed new residence. Days 3, 4, and 5, the meals and lodging could be added to this meals and lodging up to 15 days maximum. And so we'll sort of see this when we get into our first example. Now, when it comes to meals, you can choose to use this simplified method. The CRA basically sets a meal rate at $23 per meal, up to a maximum of $69 a day. So 23 times 3 is $69. So if you qualify to claim meals, then you can, rather than use all keep track of all your receipts, you can just use this simplified method of $69 a day. And this is per person. So remember we talked about traveling cost. You are driving from Vancouver to Calgary. And so let's say there's a family of 4 of you going, you, your spouse, 2 kids. And so you could claim meals for all 4 of you at $69 a day, including the hotel cost when you stay overnight in Kamloops. So you can choose to use the simplified method if you want, rather than keep track of all your receipts. And then also when you're driving from Vancouver to Calgary, rather than keep track of how many kilometers and all the gas receipts, you can use these prescribed rates. Basically, the CRA sets a rate per kilometer, but it differs from province to province. And so if you're moving from Vancouver to Calgary and you decide to use this prescribed rate per kilometer that you use to calculate your mileage from Vancouver to Calgary, you just have to figure out the distance, and then you can use the BC prescribed rate because it's always based on where the move began, not where the move is going to. So you would use the BC prescribed rate per kilometer to figure out what your traveling costs were when you drove from Vancouver to Calgary. So we're going to see all of this in play when we do our first example here. Any questions before we jump into our first example? So let's look at assignment problem 9.2. So Elaine resigned from her job in Halifax, and she began to look for a new job, and she found a new job in Regina. So she's moving from Halifax, Nova Scotia to Regina, Saskatchewan, and she's starting her new job on October the 1st. Before she started her new job, she flew to Regina to find living accommodations. So that's what we were talking about, the house hunting trip. So house hunting trips are not deductible unless she confirms a new residence. Then the days after would qualify just the meals and lodging. So let's see what happens. So on the first day, she made an offer. It was immediately accepted, and basically everything was confirmed by the third day. And she remained in Regina for an additional 3 days to buy furniture and appliances. So she spent a total of 6 days in Regina. And now we got to figure out, okay, for the house hunting trip, the flight, those amounts are not deductible. But for basically the days after she sort of confirmed her new home, those days, meals and lodging were qualified. Now, it says that the purchase was concluded on the third day. And so basically everything was finalized by the end of day 2. And this is sort of where I have to when I did this question myself, I only used 3 days for the meals and lodging, day 4, 5, and 6. But because she stayed in Regina for 6 days, that third day, everything was already concluded. So when I looked at the solution, it said we would include the meals and lodging for days 3, 4, 5, and 6. And so sort of their rationale, sort of looking at what the solution said was that everything was already done by day 3. So basically everything had been finalized by the end of day 2 because everything closed on day 3. So everything was finalized by the second day. So the meals and lodging we would include for days 3, 4, 5, and 6. Now, we can only include the meals and lodging. Her hotel was $150 a night. We cannot include the airfare. We cannot include car rental, but we can include the food. But this is sort of where I want to bring us to the end of the question quickly. If we look at the last part of the question, it says that she's going to use the simplified method to determine her automobile and food expenses. The driving from Nova Scotia to Saskatchewan, we have the prescribed kilometer amount for Nova Scotia and the prescribed kilometer amount for Saskatchewan. We'll get to that later, but she's also going to use the flat meal rate of $69 a day. So what we can do then is for these 4 days, we can basically include meals at $69 per day and lodging or hotel at $150 per day. Now, this is going to be part of that 15-day maximum that we talked about. So she can only include up to 15 days of meals and lodging for meals and hotel costs, either close to her old or new location. So what we're going to do is we're just sort of put this, we'll track it over here. Let's sort of track this down here. So this would be sort of the 4 days as part of the house hunting trip. So it's basically going to be 69 for the meals, $50 for the hotel. So that's going to be basically $219 per day times 4 days. And that's going to give us a total of $876. But we're going to just leave that there because maybe there's other amounts that can be part of this 15-day maximum that might be more than the $219 per day. Because if we have more than 15 days, we'll pick the days with the highest amount per day as our expenses. Let's continue on. On her return to Halifax, she basically sold her house. There was real estate commission, legal fees. So remember we said that when you sell your house at the old location, those legal, those selling costs, the legal, the commissions, those are eligible moving expenses. So the 9,500 and the 1,400. Now this unpaid property tax on the old home, that is not deductible. So usually when you sell a property, because property tax is paid usually twice a year, sometimes there could be a situation where the property is sold, but because the property tax payment hasn't been made yet, it will be adjusted on the statement when you sell the house. And so that's sort of what the lawyers and the notaries do. So that property tax amount is not going to be deductible. She also bought a new house. I remember we said that when you buy a new house in the new location, you can deduct those legal and other costs of buying the new house, provided you sold a house in the old location. Because she did sell a house in Nova Scotia, she's also able to include the 1,850 and the 600 as part of the cost to buy the new house. So let's keep track of all these amounts. So the eligible moving expenses. So the sale of the old and purchase of the new. The amounts we're going to include are going to be the 9,500, the 1,400, 1,850, and the 600. I think I got that right. And so I'll just sort of put the total here. Let's just make sure we got the right amounts. 9,500, 1,400, 1,850, and 600, and 13,350. And so those of you that are planning to pursue your CPA, if you end up working in an accounting firm and you're doing individual tax returns, and we're in the heart of T1 season right now, client comes in, new client. I just moved here from Calgary. I moved to Vancouver. Here are all my expenses for my moving cost. And basically you as the accountant have to sort of sort through all these expenses and figure out which ones are deductible and which ones are not. So these costs associated with selling the old and buying the new would be eligible. Any questions to this part? So let's continue on. On August 31st, she basically packed up everything in her Halifax home and spent 3 nights in Halifax before departing. And so once again, this is part of that 15-day maximum close to her old or new location. So 3 nights in Halifax and also the meals. So this hotel is $140 for the meal. She's using the 69 prescribed rate. So this will be part of that 15-day maximum. So down here, this 15-day maximum, 3 days. This is near Halifax. And this is 69 for the meals, and the hotel is 140. So this is going to work out to 209 per day and 3 days. And so this will total 627. So we'll just leave that there for now. Once again, we're going to keep track of all these amounts, and we'll take the 15 days if she exceeds 15 days with the maximum amount per day. On the morning of September the 3rd, she's going to leave Halifax by automobile, and she'll arrive in Regina on the evening of September the 10th. The distance traveled was 3,900 kilometers. So this is where we talk about the traveling cost. So rather than keep track of the gas, she's going to use the prescribed rate based on the province that she left from. 3,900 kilometers. The province she left was with Nova Scotia down here. So 3,900 times 58 cents per kilometer. Let's add that to our list here. So let's just put car travel. So 3,900 kilometers. We use the Nova Scotia rate, which is 58 cents. So this is the Nova Scotia rate. And if we work through that calculation, 0.58 times 3,900, we're going to get 2,262. Now, in addition to that, if we look up here, the traveling costs, we can also include the meals and lodging. So we can also include the meals and also the lodging while she is traveling. This is not part of the 15-day maximum because this is while she's actually driving from Halifax to Regina. So all of the meals and lodging qualify. And this is sort of where it gets a little bit confusing because she leaves on September 3rd, and then she arrives on September the 10th evening. So let's think about how many days of meals she has. September the 3rd, 4th, 5th, 6th, 7th, 8th, 9th, 10th. So she has 8 days of meals at $69 per day. So for the meals, that's going to be $552. Now, once again, this is where it gets confusing. What about the hotel? Well, she's going to be traveling and in a hotel while traveling on the night of September 3rd, 4th, 5th, 6th, 7th, 8th, and 9th. When she gets to Regina on the 10th, she will already be in Regina. So the night of the 10th is not part of the traveling cost because she is already in the new location. So there's only going to be 7 nights of hotels. And once again, if we look at the hotel cost here, it is at $140 a night. That includes when she was traveling. And then also she's staying in a hotel in Regina for a number of days as well after she arrived on the 10th. But let's just worry about the days, the nights that she was traveling. So 7 nights while she was traveling. And that's going to be at $140 per night. And so that's going to be $980. So once again, it gets a little bit confusing, but we realize that she's leaving on the 3rd and she gets in on the evening of the 10th. So meals for all those days. But for the hotel while she's traveling, every night except for September the 10th, because September the 10th, she is already staying in Regina, not on the road. So let's talk about what happens when she gets to Regina. When she gets to Regina, her new residence is not yet ready. So she's forced to continue staying in a hotel until September 26th. That's part of that 15-day maximum that we talked about. While she is now at her new location, she can't yet move in. So those days of meals and lodging, hotel, can be part of that 15-day maximum. And once again, this is again where it gets confusing because we did not include September the 10th here, right? Because we said that she is already in Regina, but we did include the meals because she was traveling and she did not get to Regina until the evening. So she ate while she was traveling. So when we talk about this time that she was in Regina, before moving into new home, we're going to have to sort of once again think about how many meals, how many days of meals, and how many nights in hotels. So let's sort of talk about the meals. So we're going to include September 11th to the 26th because the September the 10th, she was actually still driving to Regina. So that meal was included up here for September the 10th. But September the 11th, we can include. And once again, she's not moving into her new home until probably later on the 26th. So for the meals, we're going to basically include, this would be a total of 16.
Hi, Ronald, I just have a question
Yeah, for
about
sure.
the meals. So, um, so with the meals, would you be taking the full deduction, or is the $69 a day just the cap? So if I only spend maybe $40 in that day, would I only get the $40 deduction, or can I take the whole thing
Yeah,
regardless?
so Sam, if you choose to use the prescribed rate, which is the $69, you can claim the whole amount. You don't even have to spend a dime if you don't want.
Okay,
So
sounds good.
yeah,
Thank you.
yeah. So if you only spend, let's say, $10 and you choose to use the prescribed method, you can claim the whole $69 per day. And so that's what a lot of taxpayers will probably do because they're probably not going to be eating really lavish meals when they're actually traveling, probably a lot of quick fast foods. And so most taxpayers, when they're calculating their moving expenses, will probably use the $69 because that's probably going to be more than they actually spend. Now, what if you spend more than the $69? As long as it's reasonable, that's sort of what the CRA uses, just sort of a reasonability test. So let's say she's in Regina and she decides not to use the prescribed rate of $69 a day. She decides to keep track of all her receipts. If she spends more than that, but it's sort of a reasonable amount, maybe $75 a day, then I'm sure the CRA would not have an issue with it. But if she ends up spending like $200 a day on meals, then the CRA may say that that's not reasonable and may basically deny those meals expenses. But as long as it's reasonable, you can use your own expenses. But if you prefer to use the $69 a day, you can do that as well. It doesn't matter then actually how much you spend. Hopefully that answers your question. If not, let me know.
Yeah, makes sense. Thank you.
Perfect. Let's talk about the hotel then. So remember we said that for the hotel, the night of the 10th, we did not include here because she was not traveling. So for the hotel then, we would include the evening of September the 10th. But if you think about it, she's going to be moving into her new home and she'll be in her new home by the evening of the 26th. So she will be checking out on the morning of September 26th. So we will not include the evening of September 26th for the hotel, but we will include the evening of September the 10th. So this will also work out to 16 days as well. So this one also works out evenly because when you think about it, we're going to have meals of 69 and the hotel again was 140. So this is going to be 209 per day times 16 days. And this is going to be 3,344. Now we've exceeded the 15 days because we had 4 days here, 3 days here, and we have 16 days here. So we have now exceeded the 15 days. We'll come back to this. We'll sort of deal with the rest of the question first, and then we'll come back and figure out which 15 days we're going to take. So what happens next? After she moves into her new residence, she had to pay the moving company a total of $3,800. That included $675 for storage. So remember we said that when you're paying a moving company the transportation and storage costs, that is all allowable. So we can claim the full $3,800. That $3,800 includes this $675 storage. So we don't have to remove the storage amount of $675 because that is allowable as well. So we can include the full 3,800. So let's add that to our list up here. The moving company. So 3,800, that would be allowed as well. Let's see what else we have here. her income from the new job is 16,500. Her income from the job in Halifax was 32,000. So that's, why don't we just sort of summarize her income down here? So why don't we just sort of summarize? So for the 2024 year, her in 3A, we would include the income from both jobs, 32,000 plus the 16,500, and that would equal 48,500. But remember, the reason that that's relevant is because we can only claim moving expenses up to the income from the new location, which is the 16,500. So that's why that's relevant. And that brings us to the end of the question. So now we need to figure out, of those 15-day maximum amounts, which amounts will we be using? So let's go and look at the 15 days maximum close to the old or new location. The 4 days are at 219. So that's the highest. We're going to choose those 4 for sure. The remaining amounts are 209 a day. So it doesn't really matter. We know that we're going to take 4 days at 219. So the remaining 11 days will be at 209. So it doesn't matter which of the 11 days we pick, because the remaining days are at 209 per day. So what we can do then is bring those amounts up here. So 15-day max, close to old or new. And so for this, we're going to have 4 at 219. And so that's going to be the 876. And then we're going to have 11 days at 209. And that's going to be 2299. And then we can basically just add up this here. This would be basically the total allowable moving expenses that she could claim. Well, it's going to be 24,119. Any questions about the total, first of all? So let's just sort of see what would happen on her 2024 T1. Let's just sort of summarize everything here. So in 3A, she would include her employment income. Nothing, we don't know if there's anything in 3B, we'll just assume that there's nothing. And so in 3C, we have her moving expenses. But once again, this is going to be limited to from the new location. So the only amount that she could deduct would be 16,500. So in 3C, it would be limited to the income from the new location, which is 16,500. So even though the total moving expenses is 24,119, she would claim 16,500 in 2024. And then the remainder, so what do we have as the remainder? The remainder is going to be, what would that be? 7,619. We'll just double check. 4119. No, it's going to be 7,619. The remainder will be unused and carry forward to next year and can be used next year as a 3C deduction against, again, income from the Regina job. So essentially, it's just a matter of going through all the expenses, trying to figure out which ones qualify, which ones don't. And once again, if there's a lot of hotels and lodging close to the old or new location, then you sort of have to add up the daily amounts and figure out based on sort of the meals and lodging amounts, which ones have the highest amounts per day, claim those first, and then basically whatever amounts that you still need to get to the 15-day maximum, you can use the lower amounts for that. Any questions about the moving expense question? So that's one of those 3C deductions that we talked about. The next one we're going to talk about is childcare costs. So let's move down here and talk about childcare costs, childcare expenses. And so the premise is that if a taxpayer has to incur childcare costs because they need someone to take care of the kids in order for them to earn income, then those childcare costs are deductible. Or if they are, let's say, going to school full time and they need someone to take care of the kids while they're in classes, that again would qualify as well. But there's sort of some rules that need to sort of be worked through in order to figure out how much is deductible. But let's talk about some definitions first of all. Only childcare costs paid for eligible children are allowable. So who is an eligible child? So it has to be a dependent child under 16 at some point during the year. And so basically they have to be in the year they turn 16, that's the last year you can claim childcare costs for that child because they were under 16 at some point during the year. Or if the child is 16 or older and they have an infirmity, then you can claim childcare costs for that child as well. So remember in chapter 4, when we went through all those tax credits, and we talked about the term mental or physical infirmity. So if the child happens to be 16 or older, but they have a mental or physical infirmity, they need care while the parent is working, then that would also be an eligible child as well. But there's also another limitation as well. The child income cannot exceed the basic personal amount. And for 2024, if you remember from chapter 4, the basic personal amount is $15,705. So even if the child is 5 years old, but their income for the year is more than $15,705, then they would not be eligible for the parent to claim childcare expenses. So what that sort of means is that if the child is under 16 at some point during the year, but let's say they're 13 years old and they're already making $25,000 a year from part-time jobs during the school year and working full-time during the summer, then they're not going to need childcare because they're working and they're earning all this income. So that's sort of where that income amount comes from, is that if the child is already making all this money, more than the basic personal amount, then they will no longer be an eligible child for childcare expense purposes. Number 2, this is sort of what the government says should be the maximum. If the child is disabled, regardless of their age, then the maximum that you can claim is $11,000 for that child. If the child is under 7 at some point during the year, the maximum that you can claim is $8,000 for that child. If you have 2 children under 7, then it'd be 8,000 times 2. If the child is between 7 and 16, or if they're over 16, but once again with the mental or physical infirmity, then the maximum you can claim for that child is $5,000. So these annual amounts are set by the government. And then we have this term which is called the periodic amount. The periodic amount is 1/40th of the annual amount. So if we look at the first amount above 11,000 times 1/40th, that's going to give us 275. If we look at the next amount, the annual amount, 8,000 times 1/40th, that's going to be 200. And then the third annual amount, the 5,000 times 1/40th, that's going to be 125. So we'll see where this periodic amount comes into play later. but that's what the periodic amount is 1/40 of those annual amounts. And then we have this definition of earned income. Basically, the child care expense is limited to a percentage of the taxpayer's earned income. So what is earned income? Earned income is your gross employment income before you make any deductions. It's also your net business income. And it's also any income that relates to scholarships, training allowances, and research grants. So we'll go through this definition when we go through our example, but there's this definition called earned income as it relates to childcare expenses. Now, this definition of earned income will be different from the earned income we're going to see next week when we talk about RRSPs. So the earned income we're going to look at today relates just to childcare expenses. Next week, when we go into RRSPs, there will be another earned income definition, but that relates just for RRSPs. And then the definition supporting person, that's basically just the child's parent or the spouse or common law partner of the child's parents. If the child's parent is maybe divorced and they remarried, then their new spouse would also be considered a supporting person. The way that the child care expense rules work basically says that only the lower income spouse may claim child care expenses. So what is the rationale behind that? And this is not going to fit for every single family, but the rationale for saying that only the lower income spouse can claim childcare expenses is based on sort of this scenario. Let's say we have this couple and they have some small children that need childcare. And one of the parents is not working. Maybe they're wealthy enough so that one parent does not have to work. But they're so wealthy that they hire someone to take care of the kids. Because the lower income spouse is not working, they should not be able to claim childcare expenses because even if they hire somebody, they are able to take care of the children because they are not working. So that's sort of where the argument comes from, that only the lower income spouse may claim childcare expenses. There are some exceptions when the higher income spouse can claim childcare expenses. We'll talk about that next. But the lower income spouse is based on their net income for tax purposes, 3A plus 3B minus 3C minus 3D. So it's based on that net income amount that will determine which is the lower income spouse. The lower income spouse can claim childcare expenses based on the least of these three amounts: the actual amount paid, the sum of the annual amounts. The annual amounts again are the 11,000, the 8,000, the 5,000, or 2/3 of their earned income. Remember that definition of earned income that we talked about? We figure out the earned income for the lower income spouse, and then we would multiply that by 2/3, and the deduction they can make is the least of these three amounts. Now, there are some exceptions when the higher income spouse can make a deduction. Now, obviously, it would be more beneficial for the higher income spouse to deduct the childcare expenses because they have a higher income. They might be in a higher tax bracket. But the higher income spouse can only deduct childcare expenses if the lower income spouse is at school. So let's say they're going to college, university to pursue their degree. Obviously, then the lower income spouse cannot take care of the kids. So there is a situation where the higher income spouse could make some of the claim, not all, maybe just some of the deduction. The lower income spouse is incapable or has an infirmity lasting for at least 2 weeks. Maybe they are in the hospital. The lower income spouse has a mental or physical infirmity. Maybe they were in a car accident and they are basically they can't move around. They have a physical infirmity for 4 months until they recover. Then the higher income spouse can make some of the claim. The lower income spouse is in prison. or if they become separated. Those are situations when the higher income spouse may make a claim. Now, the higher income spouse's claim is also going to be the least of these three amounts, but there's also going to be a fourth amount as well based on the periodic amounts. Remember those periodic amounts? The 1/40th of the annual amount. Now, I realize this seems really confusing, so let's put these rules into an example. And the example we're going to look at is right over here. So we have this couple, Mr. Morena and Mrs. Morena. Mr. carries on a business as a sole proprietorship. He did that for the first 8 months of the year. The business was not successful. It basically broke even, so the business income was nil. After that, he terminated the business and started working full-time as an employee. And his employment income for the last 4 months of the year, $20,000. He also had interest income. He also had non-eligible dividends. Mrs. Morena worked throughout 2024. This was her gross employment income. She also made some RPP contributions, and that was all she had. So let's just sort of stop there. The first thing we need to do then is figure out which is the lower income spouse based on net income for tax purposes. So let's look at Mr. Morena over here, and then we'll do Mrs. Morena over here. So let's look at Mr. Morena's income. He had employment income of $20,000. He also had interest income of $3,500, and then also a non-eligible dividend of $62,000. Now, if you remember from chapter 7, when we did property income, we said that dividends need to be grossed up. So when we're trying to figure out the net income for tax purposes, we have to gross up this dividend. And this is sort of where we have to go to our rates table. So let's bring up the rates table to remember what the gross ups were for the dividends that we talked about in chapter 7. So here is the rates table. And let's scroll down, page 3, page 4, page 5. Dividends. So these are non-eligible. So these are grossed up by 15%. Now, we don't have to worry about the dividend tax credit because all we're trying to do is calculate net income for tax purposes, but we do have to gross up the non-eligible dividends by 15%. So let's do that here. So 15% gross up. So let's add that times 1.5, 9,300. So the taxable or grossed up dividend is going to be 71,300. And so his net income for tax purposes is going to be 94,800. So we're just trying to figure out which is the lower income spouse based on net income for tax purposes. Then we have Mrs. Morena, and all she had was gross employment income of 73,200. But if you remember from chapter 3, her gross employment income was 73,200, from which 4,200 was deducted for her RPP contributions. Remember in chapter 3, we said the government wants Canadians to start saving for retirement. So if you put money into an employer-sponsored pension plan, an RPP, that 4,200 gets deducted when you're calculating your net employment income. So over here, we have the RPP deduction minus 4,200. So her net employment income is going to be 69,000, and she doesn't have any other income. So her net income for tax purposes is going to be 69,000. And if we look at the two individuals, Mrs. Morena is the lower income spouse. So basically, she is the one that has to claim the childcare expenses unless one of those exceptions are met. So let's continue on with the question. In 2024, she attended an accounting course at a local college, lasted 12 weeks, required her to spend at least 20 hours a week in class and preparing for assignments. And so this met one of the conditions. If you go back to those conditions up here, when can the higher income spouse claim childcare expenses? If the lower income spouse is going to school and the program must not be less than 3 weeks, it lasted for 12 weeks, and it must be at least 10 hours a week full-time or 12 hours per month part-time. Now it sounds like, let's go up here, back to the question down here. It was basically full-time. It lasted 12 weeks, 20 hours of class and assignment preparation per week. So she was in school for 12 weeks. And so Mr. Morena may be able to make some claim. The actual amount they spent for childcare costs was $16,250. So we want him to claim as much as possible. And then if he isn't able to claim all of it, then she can claim some of it as well. Let's look at situation A. In scenario A, they have 2 kids. Neither are on the disability tax credit, and the ages are 1 and 3. So let's then figure out what each of the spouses can claim for the child care expenses. So because Mrs. was in college, it was college, Mr. may claim some of the child care costs. So in this situation, we're going to work on his first. So his child care expense claim is the least of 4 amounts. So remember we said that it's the least of 3 amounts, right? These 3 amounts here. But when the higher income spouse is making a claim, they have a 4th limitation, which is this one here. Now, this information is on your rates table, but, once again, I'll sort of show you where it is on the rates table, but I've summarized it all here on the handout, but I'll show you where it is on the rates table. If you go back to the rates table where we were looking at the dividends, if we just scroll backwards. No, actually, maybe we scroll forward. Hold on a second. Yeah, maybe, sorry, we scroll forward. Here it is, childcare expenses right here. So can I just summarize what we talked about? Those are sort of the least of 3 amounts. The first amount is the actual amount paid. The second amount is the annual amounts, the 11,000, 8,000, 5,000. And then the third amount is 2/3 of the earned income. So it doesn't talk about the higher income spouse. The higher income spouse has that 4th limitation, but this is sort of where it's sort of summarized on the rates table. So let's go back to our Excel document and let's look at how much he can claim. So the amount that he can claim is the least of the actual amount paid. So how much was actually paid? $16,250. That is given in the question. So in the question, $16,250 is the actual amount paid. And then we look at the total of the annual amounts. So the kids are aged 1 and 3. And if we look at the annual amounts up here, if the kids' ages are under 7, it's 8,000 per child. So that's going to be 8,000 times 2. And so that's going to be 16,000. And then we have 2/3. Now this is his earned income. Because we're doing his claim. So what is earned income? Again, for childcare expenses, earned income right here is your gross employment income, any net business income. We ignore any business losses. So for him, he only has gross employment income as part of earned income, because his other income was interest and dividends. Those are not included in earned income for childcare calculations. So we would only include the 20,000 of employment income. So 2/3 of his earned income, which is 20,000. So we multiply that by 2/3, and that's going to be 13,333. But remember, we said there's also a fourth limitation. That fourth limitation is based on the number of weeks she cannot take care of the kids because she's going to college. And so we go up here. The fourth limitation is the sum of the periodic amounts times the number of weeks the lower income spouse was not able to take care of the kids. So what are those periodic amounts? Well, the periodic amounts are 1/40th of the annual amount. So which annual amount are we looking at? We're looking at the 8,000 because the kids were 1 and 3. And so the periodic amount for 8,000, 1/40th, is going to be 200. So basically this is saying that for every week she cannot take care of the kids, he can claim $200 per week per child. That's going to be the fourth limitation. So the fourth limitation is going to be the periodic amount, which in this case for the 1 and 3-year-old is going to be 200. Now there's 2 kids. And then we're going to multiply it by the number of weeks that she was in college, which is 12 weeks. And so this is going to be 200 per week times 2 kids times 12 weeks. And so that's going to be 4,800. Any questions about these 4 calculations here? So he can claim the least of these 4 amounts. So that's going to be 4,800. So Mr. may claim 4,800 in childcare expenses. Then we consider how much she can claim. So her claim is going to be the least of only 3 amounts because she's not the higher income spouse. So it's going to be the least of the actual, the annual, and 2/3 of her earned income. Now the first 2 amounts are going to be the same, right? The actual amount doesn't change, 16,250. The annual amount doesn't change because the kids are still the same age. The only amount that will change will be her earned income. So once again, if we look at her income sources, she has employment income, and so that would qualify as earned income. But then the question is, do we use the 73,200 or the 69,000? And this is where we have to go back to the definition of earned income. Earned income is the gross employment income before any deductions. So for purposes of childcare expenses, we would include the 73,200, the gross amount before any deductions. So her earned income is going to be 73,200. So 2/3 of that, let's go 73,200 times 0.66667, that's 2/3. So basically 48,800. So let's just round it to the nearest dollar. 48,800 would be 2/3. Now, when we look at this then, the lowest of the amounts is 16,000. But her claim will now have to be reduced by how much he claimed. So the lowest amount is 16,000, and we're going to reduce by the 4,800 that Mr. claimed. And so her claim is going to be $11,200. This will be the amount of child care expenses claimed by Mrs. Moreno. So we figure out the least of the three amounts, but that has to be reduced by how much he already claimed, which is 4,800. And so she can claim 11,200. Any questions about her claim? Now there's a part B to this question, and I'm not going to go through part B, but I'll give you the answers. So answer for part B, and then you can just sort of do on your own. So for part B, Mr. Morena can claim 6,300 and Mrs. Morena can claim 9,950. So I'll let you sort of work through that on your own when you are studying for the final exam. The only difference is in part B, they have 3 children and none of them qualify for the disability tax credit, but their ages are different, 3, 5, and 14. So for part B, Mr. Morena can claim 6,300. Mrs. Morena can claim 9,950, and working on your own, and you should get these answers for part B. So we dealt with moving expenses and we dealt with childcare expenses. The third 3C deduction is spousal support paid. So let's talk about spousal support paid. Now, spousal support payments are deductible by the payer. So whoever is making the payment gets a 3C deduction. But the recipient also is going to be taxed on that. So if you are receiving spousal support, you have to include it in your income in 3A. Now, the textbook talks about the 5 conditions that have to be made in order for the spousal support payments to be deductible. Just as long as they're sort of periodic, sort of paid every month, they're basically to help the recipient with their expenses. The recipient can use the money for whatever they want, as not specifically needed to be used for rent, for example. It's because of a marriage breakdown and they are living apart, and it's pursuant to some sort of legal order. As long as those 5 conditions are met, then the spousal support that is paid is deductible by the spouse that is paying it, but it's also included in the income of the recipient. Now, child support is different. Child support is not deductible by the person that's paying it, and also not included in income by the recipient. And so sort of the rationale for that is, well, these are your kids, even if you're divorced or separated, they're your kids. If you're paying the child support, you would be having to pay for the child support regardless if you were even married. So that's why sort of it's not deductible. But spousal support is deductible, but it's also taxable in the hands of the recipient. Now, there comes a question then, what if the spouse that is making the payments is paying both spousal and child support, but in a particular year, they don't make the full payment? Then what happens? So let's look at this example here. We have this taxpayer. They're supposed to be paying $1,000 a month. That is comprised of $400 for spousal support and $600 for child support. Let's say in the current year, they only pay $8,000. How do we figure out what belongs to spousal support and what belongs to child support? So if the full amount is not paid, then the amount paid is first designated as child support. So basically it penalizes the payer, saying that if you don't pay the full amount, then we're going to treat the amount you paid first as all child support, because then you cannot deduct it. So we look at the 8,000, it's going to be first designated as child support. which is $600 per month times 12 months. And so 7,200 will be designated as child support. The remainder, which is 8,000 minus 7,200, so the remainder of 800 will be treated as spousal support. So what does that mean? The payer may only deduct 8,000 in 3C as spousal support. What that also means is that the recipient, the person that is receiving the payments, the recipient, will only have to include 800 in 3A as spousal support received. So the recipient will only be taxed on the 800 because this first 7,200 is going to be designated as child support. So that's a fairly easy to understand concept. Any questions about that? We have quite a bit to cover tonight, so I'm just going to continue on and get through the next part before we take a break. So the next part talks about registered savings plans. Whenever you hear about registered plans, it means that it's sort of registered with a bank, some sort of financial institutions. That way, the bank or financial institution can sort of keep track of all the payments into these registered savings plan. The first one is a tax-free savings account. And this is something that was introduced back in 2009, so it's relatively new. But basically, any money that you put into a tax-free savings account, it can basically grow tax-free. All the earnings will accumulate within the tax-free savings account tax-free. The amount that you put in, though, you do not get a deduction. So when you put money into a tax-free savings account, you do not get a 3C deduction, unlike an RRSP where you get that 3C deduction. But all the earnings, when it's in the tax-free savings account, if you put money in and you invest it into exchange traded funds, into some term deposits, all those earnings will accumulate tax-free. And when you take money out of a tax-free savings account, that is tax-free as well. So let me just sort of give you an example. So let's say that we put 7,000 into a tax-free savings account. Now, the amount that you can put in every year is a limit. It started out at 5,000 per year, and then it increased to 5,500 in 2013. It increased to 10,000 in 2015. Then it went back down to 5,500. And then in 2019, it went to 6,000. And then 2023, 6,500. Last year, 7,000. So these amounts carry over. But you have to be 18 or older to open up a tax-free savings account. So let's say in 2009, you turned 18, but you never put money into a tax-free savings account. The 5,000 limit will carry over. The 5,500 in 2013 will carry over. So all these amounts will carry over. So if you've never put money into a tax-free savings account, you add up all the amounts for the years that you were 18 and older. Now you have this huge contribution room that's available to put money into a tax-free savings account. So let's say for this example, we put 7,000 into the tax-free savings account. We invest in exchange traded funds, and there is $4,000 of growth. So that growth will be tax-free. So you put money into a tax-free savings account, the growth will be tax-free. So now your tax-free savings account has a value of 11,000. And so then let's say you want to buy a car or maybe go on a trip. You can basically withdraw the full or partial 11,000 tax-free. And what happens is when you withdraw, let's say you do withdraw 11,000, the following year, you can basically recontribute the 11,000 that you took out. That's not going to affect your contributions that you can make every year, the 7,000 that you can make in 2024. So you put money in, you invest it, it grows, that growth is tax-free. You take money out, the amount you take out, you can put back in the following year, and that won't affect the amount of those yearly contributions that you can still add every year on top of that. The growth is tax-free, but because of that, losses are also not deductible. I sort of had this conversation with one of my neighbors once. He realized I had a tax background, and so he opened up a tax-free savings account. He used it to trade stocks. Unfortunately, those stocks lost a lot of money, and he was really upset because he could not deduct the losses. So it's sort of, good and bad. If it grows, that's tax-free, but if you lose money, those losses are not deductible. This is known as tax avoidance because the growth is tax-free, and when you take the money out, you don't have to take up included income. So this is known as tax avoidance. This is sort of differs from RRSPs, which we'll talk about next week. RRSPs are known as tax deferrals. So let's just talk quickly about RRSPs. For RRSPs, let's say that you contribute $7,000 into RRSP. And so the year that you contribute, so this year, you're going to get a 3C deduction for 7,000, and that basically reduces your income, and so basically that's going to reduce the tax payable. But then when you retire and you take money out of the RRSP, the amount withdrawn is included in 3A as income, basically your pension income. And so this is when you pay tax on it. This is known as tax deferral. Oh, so this should say differs. This differs from RSPs, and RSPs are known as tax deferral. So tax deferral, you're basically just not paying the tax in the year that you make the contribution. You're deferring it till a later point in time, usually when you retire and you take the money out of your RSP. So RSPs refers to tax deferral. You will eventually pay tax on it, just not until later on. But with a tax-free savings account, all that growth will be tax-free. The same thing with RSPs. When you put money into an RSP, one thing I should add here as well is that while the money is in the RSP, any growth is also deferred. So when you put money into an RSP, that's 7,000, you're probably also going to invest it into term deposits, exchange traded funds, and is also going to grow, is going to earn interest income, maybe some dividends or capital gains. All that growth will not be taxed until you take the money out when you retire, probably. So just the difference between tax-free savings account, that's known as tax avoidance, RSPs known as tax deferral. Both are useful ways to invest, but they sort of have different circumstances. Any questions about this discussion? Another registered plan, remember when we talk about registered plan means that you set it up with a bank, a financial institution, they take down your social insurance number so they can keep track of how much you put into a tax-free savings account, how much you put into an RSP, and they report that to the government. Another registered plan is registered education savings plan. This basically allows parents and grandparents to save for their children's or grandchildren's education. And so some of you, maybe some of your parents set up a registered education savings plan for you. And so now that you're going to university, they can basically have you take money out of that plan to help pay for your university tuition and books. I kind of summarized all the rules here, but I think that's sort of the best way to sort of explain this is just sort of to draw a diagram. So let's just sort of talk a little bit about RESPs, Registered Education Savings Plan. This basically allows parents and grandparents to save now for child post-secondary education. So the parents and the grandparents, they are known as the subscribers. So they are the subscribers to the plan. The subscribers can basically put in they're going to put in money into the RESP. When they put the money in, there's no deduction. So this is not like an RRSP where you get a deduction. They're going to put money into this RESP. So they're going to put money into this RESP. And the maximum they can put in over the years of $50,000 per child. So if they have more than one child, they can only put a RESP for each child, but a maximum of $50,000 per child. Now this money can also be invested. So let's say over the years they put in 50,000, not all at once, you know, it's obviously probably going to be spread out over a number of years. This money is invested, and let's say there's $20,000 of investment earnings, so of growth. This is also tax deferred. It will not be taxed until the money is taken out. Now, the government tries to encourage parents to put money into an RSP. So the government will also put in what's called the Canada Education Savings Grant. And the maximum that the government will put in over the life of this RESP is $7,200. Now there's sort of some rules that I talk about over here. The CESG talks about some sort of rules that how much the government will contribute every year is going to be 20% of the amount that the parents or grandparents put in. So you can just sort of read through that yourself, but essentially it can be a maximum over the years of $7,200. So there's no tax while all this money is in the RESP. So there's no tax while all this money is in the RESP. So then what happens? The child goes to university. And now the money can be taken out. So they will withdraw from the RESP. Now they can sort of designate where the money is coming from. If they decide to take money out of the contributions, these withdrawals will be tax-free. So if they decide to take money out of this 50,000 that was initially invested by the parents and grandparents, that's tax-free because when the parents put the 50,000 in, they did not get a deduction. They put in money after they pay taxes. And so if they take money out of the 50,000, that will be tax-free. But if they take money out of these two amounts, that was never taxed. If they take money out of either the 20,000 and or the 7,200, those withdrawals are known as education assistance payments. And these amounts will be taxed in the hands of the child, you know, basically the student now. Now, if the student doesn't have a lot of income, then they may pay little to no tax on these amounts because they have no income. Remember, the BPA is over 15,000. And so if they take out 15,000 of these education assistance payments every year, in addition to some of the amounts that are tax-free, then they may end up not having to pay any tax at all because they have very little income. So that's sort of how an RESP works. Once again, there's rules as to sort of how these operate. I summarize the rules there. And when you withdraw money from the RESP, you can basically tell the financial institution, do you want to take money out of the contributions that the parents made, or do you want to take money out of these pools here, the investment earnings, or the amount that the government put in? So you can sort of dictate where the money is coming from. But what if the child does not go to post-secondary education? What happens then? So let's say the child does not pursue post-secondary education. And once again, it's hard to really know because the parents set this up when the child was born. They wanted to save a little bit every year. And so there's no way to know that, what's going to happen when the child graduates from high school, if they're going to pursue post-secondary education or not. So let's say the child does not pursue post-secondary education. What happens then is that 50,000 is returned to the subscribers. Once again, it's going to be tax-free, right? Because the parents and the grandparents, the 50,000 they put in, that was after tax money that they had. So there's going to be no tax if that money is returned to them. Typo here, subscribers. What about the 20, so the government amount, the CESG amount, that would just be returned to the government. So that's sort of easy because they'll keep track of how much the government put in, and that amount can just be returned to the government. But what about the 20,000 in investment earnings? That will be basically prorated to the subscribers. So once again, if the parents put in some money, if the grandparents put in some money, they'll figure out how much each put in, prorate that 20,000 to the subscribers. They will include that amount in their income and pay tax on that amount based on their tax rate plus 20%. And so if you remember, all these years, this 20,000 that was earned was tax deferred. So if the child does not go to post-secondary and that 20,000 of investment earnings go back to the subscribers, it's been sitting in the RESP without having to pay any tax. So that's why there's this additional 20% tax that is added on top of their own tax rate because it was sitting in the RESP all these years without having any tax paid. Once again, just understand sort of at a high level about RESPs because there are quite detailed rules that the textbook does go into. Any questions about the RESP discussion? So we are now at 7:30. This question, this is actually a fairly easy question. Why don't we just go through this? That way we'll get it done before the break. And then when we come back from the break, we'll probably be tired, so we'll have a little bit lighter amount of material to get through after the break. So let's just, while we're on this momentum here, let's go through this problem, which sort of incorporates a number of the topics that we just talked about. So Viva went through a divorce settlement and she has custody of her two kids. Daughter is 8, son is 10. They're both in good health. She's going to get monthly child support plus monthly spousal support. This year, she received all the payments. So what are we required to do? Let's go to the required first. The required says calculate her minimum net income for 2024, and then also provide reasons for omitting items that we have not included in her net income. So let's deal with the spousal and child support. Child support is not taxable, but spousal support is if she receives it. So she's getting $2,000 a month in child support and $1,500 a month in spousal. So let's just sort of go over here. We want to calculate her net income for tax purposes. And so we know that in 3A, she's going to have to include spousal support. And that is $1,500 a month times 12 months. And so she's going to have to include 18,000 for spousal support. And then let's just put, we do not include, so the amounts we are not including is child support. So child support is not taxable if you receive it. So that's the first amount. Let's continue on. In order to get a fresh start in life, she enrolls into a co-op program at the university. She's successful in the winter term. It's a co-op program, so she's required to work in the summer. So she was studying at London, in London, Ontario, at Western University, but her co-op for the summer is in Timmins, Ontario. And so during the summer months, May to August, she earned $8,000 in employment income while she was working at the co-op position in Timmins. So let's add the 8,000 to her employment income. So employment income, and this is when she was in Timmins. And that was for $8,000. At the end of August, she returned to London to finish off her studying at Western University. She was able to work part-time while she was in London, and her employment income was $1,600. So let's add that to her 3A employment income. And this is when she was in London, Ontario. $1,800. Now, she had to move. She had to move to Timmins, and then she also had to move back to London. Now, we're going to assume that these are all eligible moving expenses. They don't tell us otherwise. So her moving expenses when she moved to Timmins was $1,200, and the moving expenses when she moved back to London was $1,350. So these are all eligible moving expenses. These would be part of 3C. So let's put them down in 3C here. Let's put down the amount. So from London to Timmins, that amount was 1,200. And then from Timmins to London, that move was 1,350. So remember we said that you can only claim moving expenses up to the amount of income in the new work location. So when she moved to Timmins, she had income of 8,000. So that's below the 8,000. When she moved back to London, she had income of 1,800. So she's able to deduct all of these moving expenses because it's less than the income earned at the location she was moving to. Any questions about that? Now, in addition to her employment income, she received a scholarship. Now, in the textbook, they say most scholarships are tax-free. And they also make a point in the textbook where they say, for purposes of this textbook, just treat any scholarship income as tax-free. Situations where scholarship may not be tax-free, if maybe it's from a foreign university, it may not be tax-free. But for our purposes, we'll assume that all scholarships that are mentioned in the questions are tax-free. So that one is going to be tax-free. So under the column here where we do not include, we'll put the scholarship income. What about eligible dividends? Eligible dividends will be subject to tax, and we include that in 3A, 2,600. And so the eligible dividend $2,600. Now remember, dividends have to be grossed up. And so now we got to go to our rates table and see what is the gross up rate for eligible dividends. Let's go up here. Eligible dividends grossed up by 38%. So let's go back to our Excel document. And we're going to gross it up by 38%. $988. And so the total of that dividend is going to be $3,588. That's going to be the taxable or grossed up dividend. And what else do we have? Inheritance from an uncle. So here in Canada, there is no inheritance tax. If you're talking to an American in the United States, they do have an inheritance tax. So just know that if you're here in Canada and you receive an inheritance, it is not taxable to you, the recipient. Now, the estate may have to pay tax before it distributes money to all the heirs. But if you are the one receiving an inheritance here in Canada, that is not taxable. Remember, we set TFSA withdrawal. That is also not taxable as well. So we will not include the inheritance. And we will also not have to include the TFSA withdrawal. What about the next paragraph? Childcare. She had to pay childcare expenses, $1,950, also $1,725, and $2,175. So if we think about it, the actual childcare cost, we have $1,950 plus $1,725 plus $2,175. Is that right? $1,950, $1,725, $2,175. So the total actual childcare cost is going to be $5,850. And remember, we said that she has custody of the kids, so the child care expenses or cost deductible is going to be the least of three amounts. Remember, we just sort of did that. So that's the actual amount. And remember, there was the annual amount. The annual amount is based on those amounts that CRA sets. So how old are the kids? The kids are 8 and 10. So let's go back to our childcare cost discussion here. 8 and 10, they're between 7 and 16. And so it's going to be $5,000 per child. That's the annual amount. So let's go back to our question. So the total of the annual amount is going to be 10,000. And then the third amount is 2/3 times her earned income. And what is her earned income? So remember, we said that earned income is basically just going to be her employment income. Oh, I think I made a mistake with the employment income for Timmins, or the London amount. Let me just double check that. Yeah, so the employment income was 8,000 and 1,600. I think I put 1,800 by mistake, so it's 8,000 and 1,600. So for childcare cost purposes, the earned income would be 9,600. And so what's 2/3 of that? 9,600 times 0.66667, basically 6,400. So the childcare costs that are deductible is the least of these three amounts, and the least is going to be the actual 5,850. So under 3C, we have child care expenses that are deductible, 5,850, that goes there. And then the last paragraph, she put money into an RESP. She contributed 1,500 to each child's RESP. Remember, when you put money into an RSP, the parent does not get a deduction. So that RESP contribution, under the amounts we do not include, they do not qualify as a deduction. So we've sort of gone through everything now, and we can now quickly add up her net income for tax purposes. So her net income for tax purposes will be 22,788. Any questions about this assignment problem? So we still have quite a bit to do. We're going to finish off this handout. And once again, as I mentioned at the beginning of class, there is a second Chapter 9 handout that I posted, I think, about a day ago. So if you didn't download the second Chapter 9 handout, download that one as well. Why don't we take a break? And let's just take a 10-minute break. We will return at 7:52 p.m. So I'll see you back here in 10 minutes. Moving on to the next part of the Chapter 9 handout, we're going to talk about non-arm's length transfers of property. So what do we mean by non-arm's length? So when you think about arm, the length of your arm, if it's non-arm's length is not the full length of your arm, that means you're quite close to that person. But if you're arm's length, that means that you're not close to that person. So when we talk about non-arm's length transfers, we're basically talking about transfers between related individuals. So transfers between you and your parents, your grandparents, your spouse, your siblings, your children, and grandchildren. So when we talk about non-arm's length transfers, we're talking about transfers between certain parties that are related. So between you and your parents, you and your grandparents, you and your spouse, siblings, children, grandchildren. So this is sort of the rules that we need to follow if the transfer is not at fair market value. So the reason that the CRA has these rules is that if you're transferring between arm's length individuals, between people that are not related, they will likely transfer property at fair market value. So everything will be okay. But if we're talking about non-arm's length individuals, they may decide to transfer property maybe above fair market value, below fair market value, or maybe they'll just give it as a gift. And so this chart here basically tells us if the transfer is not at fair market value and it's between non-arm's length parties, what is going to be the proceeds for the person giving up the property, the transferor, and what's going to be the cost for the person receiving the property, the transferee. So let's go through this example together. Sue owns a non-depreciable asset, so it could be maybe land, for example, or maybe some investments. The fair market value is 500,000, and the adjusted cost base is 200,000. So basically, if the transfer was at fair market value of 500,000, Sue would have a capital gain equal to 500,000 minus the 400,000 her cost. So she would have a capital gain of, oh, sorry, the cost is 200,000, my mistake. She would have a capital gain of 300,000. And then her sister Sally would now own the asset, and her adjusted cost base would be what she paid for it, which is 500,000. So if the transfer was at fair market value, which is 500,000, that would result in a 300,000 capital gain for Sue. And then Sally would now hold the asset with a cost of 500,000. Let's look at scenario one. Let's say Sue says, I want to minimize my capital gain. So Sally, I'm just going to sell it to you for 400,000. I don't want to sell it to you for 500,000 because the capital gain is going to be too much. So I'm just going to sell it to you for 400,000. That is going to be below fair market value. So because they are siblings, we now have to go to the chart and figure out what the tax consequences are. We are now below fair market value. So what that means is that Sue, who is the transferor, must use fair market value for proceeds of disposition. So even though she only transferred it for 400,000, she's forced to use 500,000 as her proceeds minus the cost of 200. So she's still going to have to report a capital gain of 300,000. So once again, this is below fair market value, so we have to use this row here. Sue, the transferor, is going to have to use proceeds equal to fair market value. What about Sally? Sally is the transferee. Sally's adjusted cost base will equal the actual proceeds of 400,000. So what you can see here is that if they try to use a value other than fair market value, they're going to lose 100,000 because Sue will have to use 500,000 as her proceeds, but Sally will only get the actual proceeds of 400,000 for her cost base. So there's a difference of 100,000 there. So these rules are basically put into effect to basically try to discourage non-arm's length individuals from to try to discourage them from not using try to discourage them to not use a value other than fair market value. So basically tries to force them to use fair market value when they sell property between non-arm's length parties. Otherwise, they're going to be penalized. Any questions about scenario number one? What about scenario two? Let's say Sue has a net capital loss. And remember we said that net capital losses can be used to offset taxable capital gains. And so she wants to use it all up. So she says, well, I'm going to sell it to you for 600,000 now. I want to create a bigger capital gain so I can use this net capital loss. And so this is a situation where it's going to be above fair market value. So what do we have here now? So we are now above fair market value. If we are above fair market value, Sue has to use actual proceeds, 600,000, but Sally's adjusted cost base is only going to be fair market value, which is 500,000. So let's see what happens here. So then for Sue, she'll use proceeds of 600,000 minus her cost of 200,000. She's going to report a capital gain of 400,000. And once again, 50% of that's going to be taxable. So the taxable capital gain will be 200,000. And that's what she wanted because she wants to use this net capital loss to offset it. But the only problem here is that Sally actually paid 600,000, but Sally's adjusted cost base is going to equal a fair market value of 500,000. And so once again, we lost this 100,000 extra that was paid to Sue. So once again, they're going to be penalized for using an amount other than fair market value. Even though they're creating this greater amount of capital gain, once again, it's not fair market value. So they're going to be penalized. Specifically, Sally will be penalized because she's paying 600,000, but she's only going to get an adjusted cost base of the asset for 500,000. We'll look at another question later on as well. But what we're going to do next then is talk about transfers between spouses. If the transfer is between spouses, the Income Tax Act allows certain properties to be transferred tax-free between spouses. And so this tax-free transfer is also known as a rollover. So whenever you hear the term rollover, all that means is that we're rolling over assets from one party to another. And this tax-free rollover is only allowed between spouses. So this could be done maybe for survivorship purposes. So let's look at this example here. Let's say the wife owns rental property and she wants to transfer it to her husband. Could be for many reasons, maybe for survivorship purposes. Maybe the wife has a terminal illness, and so she knows that, when she eventually passes, all of her assets will go to her husband anyway. But because this is rental property, she just wants to sort of make it easier that, let's take care of the paperwork now while she's still alive. She can help her husband transfer the property from her name to her husband. And so the Income Tax Act allows this to be done tax-free. Now, they could do it with taxes and recognize any gains and recapture, but they want to do it tax-free. So because it's a rental property, there's a land component and there's a building component. So let's look at the land first. Basically, if the land was transferred at fair market value, the fair market value would be 300,000. So that's the fair market value of the land minus the adjusted cost base of 200,000. That would basically result in a capital gain of 100,000. But with this tax-free transfer, because it's between spouses, it will deem the proceeds to equal the adjusted cost base of 200,000. So then we minus the adjusted cost base, which is 200,000, and that will result in 0 capital gain. So normally, if there was no such rule, they would have to transfer it at fair market value, result in a capital gain. But using the tax-free transfer, we can basically avoid all of this and do it tax-free. So then what will happen then is the husband now will own the land and he will hold it as with an adjusted cost base equal to the same cost that the wife held it, which was 200,000. What about for the building? The building is a depreciable asset. So because the building is a depreciable asset, we have to follow the CCA rules. So the UCC for the building is 70,000. And remember, we said that whenever we dispose of a building, we have to deduct the lesser of cost. The cost of the building is 100,000 from up above, and the proceeds, fair market value, is 150. So just sort of, if we were to sort of follow the rules, the lesser of the two would be the cost, so we would deduct 100,000. And so working through the calculations, we would now have a negative amount, whoops, of 30,000. This is recapture. And so we would have to add this to income to basically get rid of it. And that would bring this balance to 0. So if there was no special rule, they would have recapture of 30,000. And then also there would be a capital gain as well. There would be a capital gain because the building is being sold for 150, the fair market value, over the cost. So there will also be a capital gain of 50,000. But once again, if they wanted to do this using the tax-free transfer, it would basically just sort of deem this calculation here. Let me just sort of put this here. What would the difference here would be that it would just deem this proceeds here to be equal to the UCC, which is 70,000. And so we would be minusing the lesser of cost or proceeds, which is 70,000. And so this would be 0. So we can sort of avoid all of this here by using the tax-free transfer. And that would also avoid the capital gain as well, because there would be no capital gain because we're transferring it with proceeds equal to 70,000. So there would be no capital gain to report as well. And then once again, whoops, right. What would happen then is the husband now would own the building. And he would just basically take over the same values that the wife had it. The adjusted cost base of the building is 100,000. And he could then use the same UCC that the wife had of 70,000. The only sort of wrinkle in this is that they can transfer the property and he can hold on to the property and it can be all done tax-free. But because this is a rental property, it's still going to be generating rental income. It will still be generating rental income. So what that means is that any rental income earned will be attributed back to the wife, and she would have to include on her income tax return. So if they do this tax-free transfer, just to change the title for survivorship purposes, they can do that without creating any tax to the wife. But because there was no tax done on the transfer, any income that the rental property earns will still have to be reported by the wife. If they did not do this tax-free transfer and they created everything done at fair market value and she had to include all the capital gain recapture, then the husband would report the rental income. But because they did everything using this tax-free transfer, all the rental income still will be reported by her, even though this is under his name.
Is that indefinite or just for the first year?
Indefinite. Yeah, because there was no tax on the transfer of the property because it was all done to avoid tax. So that means in all the future years, any rental income would have to be reported by her, even though it's in his name.
Okay, thanks.
Yeah, you're welcome. Any other questions? So on the next page, this here is what we call income attribution. This is sort of known as income attribution, meaning the income is attributed back to the wife. I kind of summarized some income attribution rules here. You can just sort of read through them on your own. I've sort of summarized the main income attribution rules. But in the interest of time, what I want to do is do one question on this final handout that relates to these non-arm's length transfers. And then once we finish this question, we'll go to the final Chapter 9 handout. So this is sort of what we did earlier on. These are sort of the rules that we have here. Let's look at this question together. Jody is the parent. She has shares in a public company, and the cost was $220. The fair market value was $426. And so basically we see here that there's a capital gain of $206,000. And she has 3 children. Jim, her spouse is Jim. They have 3 children. Daughter Kim, 20, Jeff, 22, Jerry, 24. And she's considering selling the shares either to her daughter for $220, gifting them to the son Jerry, or selling the shares to the younger son for $500. And so what we're going to do is just sort of look at what are the consequences in each of these 3 alternatives. So let's look at the first one. Selling the shares to the daughter for $220. That's going to be below fair market value. So this first one will be below fair market value. So let's look at the below fair market value row here. And so for Jody, she's the transferor. She's going to have to use proceeds equal to fair market value, which is $426 minus the, she's going to have to use fair market value of $426 minus the adjusted cost base of $220. And so she's still going to have a capital gain of $206. So they were trying to avoid the capital gain, right? Because she sold it for $220. If it was $220 minus $220, her capital gain would be 0. But because of these non-arm's length transfer rules, she's forced to use proceeds equal to fair market value. Now, the daughter, what's the daughter's name? Kim the daughter, will have adjusted cost base equal to proceeds of $220. So if you sort of look at that, this difference here is the $206,000. So even though Jody had to use $426 as her proceeds, Kim is only going to get an adjusted cost base equal to her actual proceeds of $206. I made a typo here. That should say $206. What about in the second scenario, where it's going to be a gift? If it's a gift, once again, which row do we fall in? This one here. Even though it's a gift, they have to use fair market value. So Jody will use proceeds equal to fair market value of $426. We minus the cost of $220. So she's still going to have to report a capital gain of $206. And then the son will have adjusted cost base equal to fair market value of $426. So this one is, even though she gifted the shares to her son, this one is sort of more equitable because she the mother is using proceeds of 426, the son will also get an adjusted cost base of 426. Even though he didn't pay it, it was a gift, he will still get that 426 adjusted cost base. So that was sort of more equitable, even though it was just a gift. Any questions about the first two? What about 4C? She's going to sell the shares to the son, another son, but for a higher amount above fair market value. So this one is above fair market value. So let's look at the above fair market value row, which is this one right here, above fair market value. So Jody will use actual proceeds, but the son will only get fair market value or his adjusted cost base. So Jody will use actual. So proceeds will equal actual, which is 500 minus the adjusted cost base, which was 220. So capital gain will be 280,000. So above fair market value, Jody will use the actual amount, 500,000. That's the above fair market value. But then the son adjusted cost base will equal only fair market value of 426. So once again, there's a difference here of 74,000. So once again, that's lost because the son will not get the full 500,000 for his adjusted cost base. It would only be the lower amount, fair market value, of 426. Any questions about these non-arm's length transfers?
Yeah, for A,
Mhm.
Kim's adjusted cost base is 206. Shouldn't it be 220?
220, you're right. My mistake.
Okay.
All these numbers are sort of just blending together. Thank you for pointing that out. So yes, you're right. This should be 220. Yeah, thank you for that. Let me just double check if everything else is right. So Jody, 426, 206. Kim, 220. You're right. For the 24-year-old son, 426, 220, 206. Son, 426. For the third scenario, Jody, 500 minus 220, capital gain 280, and then the son's adjusted cost base 426. Yes, you're totally right. Thank you for pointing that out.
No problem.
Yeah. Any other questions before we go to the next handout? So as I mentioned, there is this second handout that I posted on eLearn. I'm just going to save this. I'll bring up the next handout. This deals with a bit of an advanced topic called tax on split income. And it's talked about on pages 558 to 568. It's quite a lot of material, but it's very advanced material. And so the legislation is very complex. It's abbreviated TOSI, tax on split income, also called TOSI for short. So for exam purposes, only a basic understanding is needed. It's once again very advanced material. I don't think I've actually ever dealt with TOSI when I was working in public practice. I think the only way I sort of dealt with it was indirectly. Clients want to avoid this. So because of these rules, they're made as sort of an anti-avoidance rule. They're there to basically discourage taxpayers from doing these things so that they can avoid these rules. So they're basically done as a prevention. And so you sort of, as a tax practitioner, you would understand these rules and just sort of make sure that your clients do not fall into these rules. So let me just sort of briefly summarize what these TOSI rules are sort of geared towards. So let's just sort of do some summary here. They're basically geared towards children who are shareholders of a private corporation that was set up and owned by their parents. So parents set up this private corporation and they just sold some shares to the children or gifted some shares to the children. Now there are TOSI rules for the following groups. Children that are under 18. This is sort of going to be our focus. We're just sort of going to focus on this group here, but there's also separate rules for children that are between 18 and 25, and then separate rules for children that are greater than 25. I mean, when I say children, I'm referring to like the parents are the ones that own the corporation, and the children just happen to also have some minority share ownership in the corporation as well. The rules basically will apply if the child did not contribute significantly. Oh, sorry, did not contribute or contribute or did not make a significant investment in or work, let's say considerable hours in the corporation. So these rules are basically in place where we have this child who is a shareholder of a private corporation that is basically owned by their parents. And the child did not make a significant contribution into the corporation. Maybe the parents just gifted them the shares, so they didn't really pay for the shares out of their own pocket. They're not working a considerable amount of hours. So let's just say hours, not house, or work considerable hours in the corporation. So they're basically just sort of a passive shareholder. And let me explain why we have these rules. So let's look at this example here. We have this private corporation. So we have the CCPC, Canadian Controlled Private Corporation, and there's two shareholders. The mother owns 80%, and the 10-year-old child owns 20%. So just some terminology. The mother is known as the source individual, and the child is known as the specified individual. That child is not actively engaged in the business. So they basically define that as working less than 20 hours per week. So they're not actively engaged in the business. And so the company is now going to pay a dividend to the shareholders. 80% goes to the mother, that's $80,000, and 20% goes to the child, which is $20,000. And so this is a 10-year-old child. And let's just see what would happen if there was no TOSI rules. So if we did not have these tax on split income rules, that 10-year-old child would include this non-eligible dividend of $20,000. Remember we said dividends have to be grossed up. Non-eligible dividends grossed up by 15%. So they would have a taxable dividend of $23,000. Now, they don't have any other income. And so let's say that we're going to focus on their federal tax. They're going to pay federal tax at 15%. Now, there will be provincial tax as well, but we're just going to focus on the federal tax. So the federal tax that they would pay at 15% is going to be $3,450. Now, as we learned in chapter 4, they're going to get the basic personal amount. The basic personal amount, I'm just going to move this over one row here. The basic personal amount for 2024 is $15,705. Remember, we have to multiply these tax credits by 15%. So the basic personal amount would result in a tax credit of $2,356. They would also get the dividend tax credit. And we learned how to calculate that in chapter 7. For a non-eligible dividend is 9/13 times the gross up. The gross up is 3,000. And so the dividend tax credit would be 2,077. Now remember we said that these are non-refundable tax credits. So what that means is that they have more tax credits than they do taxes owing. So the net tax owing will be 0. So basically, the mother is trying to split the income with her child. She's trying to split the dividend income with her child, knowing that the child will get the basic personal amount and the dividend tax credit. And as long as the child has no other income and they make the dividend amount such that there's no income, no taxes owing, that child will get that dividend tax-free. So that is why we have these TOSI rules, to prevent situations like this. Now, obviously, if the child is actively working in the business, or if they sort of invested in the shares, it wasn't like a gift from the mother, then that could sort of avoid the TOSI rules. But if this child, is not actively working in the business and the shares were basically just a gift, the TOSI rules would apply so that we would not have this outcome. The way that the TOSI rules work is that the split income, this 20,000, is not included in net income for tax purposes. Rather, a separate calculation is required. So they would figure out what amount is the split income. That would be separated. The split income in this example would be the non-eligible dividend of 20,000. We would still have to do the 15% gross up. And so we would add the 3,000. And so we would still have a $23,000 taxable dividend. But this amount would be taxed separately. And so the way that it's going to be taxed separately is we're going to apply the highest federal and provincial tax rate. Now we're just going to focus on the federal tax rate. The highest federal tax rate right now is 33%. If you look at your rates table, it is 33%. So the federal tax will be 23,000 times 33%, 7,590. They're only going to get the dividend tax credit. So remember the dividend tax credit, we can just sort of use the calculation we did above here. 2,077. And so there would be provincial tax as well, but the federal tax would be 5,513. So I'll just make a note. There would be provincial tax as well, using the highest provincial rate. So this is an example of tax on split income. If the income, the dividend that the child receives is from a corporation controlled by one of their parents, and they are not contributing to the corporation, that dividend is known as split income. We separate it from their net income for tax purposes. We tax it at the highest tax rate. They'll still get the dividend tax credit, but because of that, they'll end up having to pay tax. Complex rules, but let's go through a simple example down here to just sort of reinforce what we just talked about. This is an exercise from the textbook, and I know that with exercises, you do have the solutions in the study guide, but this is just a nice simple example to sort of illustrate these rules. So Norton is 16, and he receives non-eligible dividends from a private corporation controlled by his mother. So this is going to be the split income. So there's no discussion about whether he contributes to the company or not, but so we just assume that he doesn't. So this is going to be the split income, but he also has other income. He also has business income of 18,200, and he also has a bunch of stocks, and those stocks paid him eligible dividends of 8,600. His only tax credits are the basic personal amount and the dividend tax credit. So let's just sort of see what would happen with Norton. The business income and the eligible dividend, that would be part of his net income for tax purposes. And we would just sort of follow those rules to figure out how much tax he owes on those amounts. But the 15,000 will be separated. So let's just sort of see what happens with Norton. So we would have his regular T1 return. And so on the regular T1 return in 3A, we would have his business income of 18,200. And then we would have the eligible dividend. Dividend, that was 8,600. Now I'm just going to work through this quickly because it's already 8:30. The eligible dividend, the gross up is 38%. So that's going to be $3,268. So the taxable dividend going to be 11,868. And so on his regular T1, his net income for tax purposes and his taxable income will equal $30,068. Now, once again, if you look at the rates table, we're just going to focus on the federal tax only. The federal tax rate, once again, for 30,068 is going to be 15%. And so we have 4,510. I'm just going to round that to the nearest dollar, just to avoid any pennies there. So this would be the federal tax. This is just on his regular income. And then we will subtract the non-refundable tax credits. First, we have the basic personal amount. Once again, that was 15,705 times 15%. That's going to be a tax credit of 2,356. And then the dividend tax credit. This is an eligible dividend. So the federal dividend tax credit is going to be 6/11 times the gross up. The gross up from above, that's the 3,268. That's going to be 1,783. And so the federal income tax payable, this is the amount that's under sort of the regular Part 1 rules. Is going to be $371. So went through it rather quickly, but once again, fairly straightforward. Business income, the dividend is grossed up. This is his total income. We're just looking at the federal tax. So 30,068, we would have a 15% federal tax rate. So the total federal tax before non-refundable tax credits, 4,510, minus the tax credits, the basic personal amount, the federal dividend tax credit. So the federal tax under Part 1 would be $371. Any questions about this first calculation? Then we have the split income. So let's do the split income here. Is there enough room? Should be. So the split income was non-eligible dividends of 15,000. Now, non-eligible dividends, the gross up is 15%. So we have a 15% gross up. That's going to be 2,250. So then our taxable dividend is going to be 17,250. We're going to be taxed at the highest federal and provincial rate, but we're not going to worry about the provincial in our calculation here. So we'll just multiply this by the highest federal rate. There will be provincial tax as well. And so the federal tax will be 17,250 times 33%. So we're just going to round out to the nearest dollar, 5,693. On the split income calculation, they will just get the dividend tax credit. And for non-eligible dividends, this will be 9/13 of the gross up. And the gross up again was 2,250. That's right up here. So the dividend tax credit will work out to be 1,558. And so the federal income tax on the split income, 5,693 minus 1,558, 4,135. So overall, when Norton files the tax return, he will pay a total of 371 plus 4,135. And so he's going to have to pay a total of 4,506. And once again, there will be provincial income tax as well. So that's, once again, just a brief overview of this tax on split income rules. They are very complex, like I said, but because it spanned 10 pages on chapter 9, I wanted to just sort of go through it with you. Once again, the rules are very, very detailed. So just sort of understand basically what we did in class today. Don't worry about having to sort of memorize all the rules or read through the rules in a lot of detail. You can if you want, but just sort of understand sort of the basics of how these rules work and why they are in place. They're trying to prevent parents from putting their kids as shareholders, and then the kids receive dividend income, but they're actually not contributing to the company. That's where these tax on split income rules apply. Any questions about this question on tax on split income? So we did cover a lot of material this evening. Looking forward, the chapter 9 homework. I made the chapter 9 homework due on Monday, but definitely try to get it done before the deadline on Monday evening. The next week we're going to go through chapter 10. So we basically have 2 more weeks. Next week is chapter 10, and then the week after that will be chapter 11. And then our final exam happens right away, right on the Wednesday of the following week after we do chapter 11. I haven't yet written the final exam, but once I do have the final exam written, I'll sort of put the details on eLearn, and then we can answer any questions in class. The focus will be on chapters 8, 9, 10, 11, and 8, 9, 10, and 11. It is a lot of material. So if you want to start studying, just start studying using chapter 8 and 9. If there are any topics from earlier chapters, will let you know ahead of time. But for now, the chapters after midterm number 2, those will be more heavily tested on the final exam. So if you want to get started studying early, just start with chapter 8 and 9. Next week is chapter 10, and then the last week of class will be chapter 11. Any final questions before we wrap up today? No, that is it. Once again, a longer class today, a lot of material. I'll post the handouts on eLearn. I'll also post the recording on eLearn when it comes available. That is it for tonight. So everyone have a good evening, and we will see you next Wednesday night. Okay. Good night, everyone. Bye for now.
Thank you.
Bye.